Welcome to the Tepper School of Business Multimedia Series. For more information on the Tepper School at Carnegie Mellon, please visit us at www.tepper.cmu.edu/multimedia. And now, here's your selected video.
Well, good morning.
It's all relative. Right?
Great to see everyone this morning, up bright and early. We've had a very active morning already because we've had 5 various breakfasts going on throughout the building with our student clubs and also with our class of 1964 at a breakfast this morning with Dr. Egon Bayless, so it was a wonderful time for them. And now we're ready to get started here this morning, and we thank you that you know it was a little challenging getting in. Buggy races are going on outside. If you want to go out, you'll see on the large screen TV and catch the finals. A little bit later, and they'll be announcing the winners of that. But this morning, we're very honored to have with us Dr. Allan Meltzer to talk with us this morning, and we have adjusted a little bit of the talk. He'll explain a little bit of that this morning, but he is the Allan H. Meltzer University Professor of Political Economy here at the Tepper School, and he's also a visiting professor at the Hoover Institute. We'll talk a little bit about that as well. But I think most of you know that Dr. Meltzer is always in the news. If you, like me, you have a little Google alert that alerts you whenever anything goes on about Carnegie Mellon. You'll see that just about every day. There's something that Allan is speaking about as one of the world's leading experts on financial reform, monetary policy, macroeconomics, so much of what's going on in the economy these days. And of course, he's the official historian of the Federal Reserve. And as you'll see, he has been an author and made some significant contributions to the historical view of the political economy. In 2002, he published The History of the Federal Reserve from 1913 to 1951. And then in 2009, he couldn't get it in just one more volume. He had to get it in a volume 2, but 2 books that did that and covered all the way up to 1986. And a little bit on the financial crisis that got added in there as well. So he's been an amazing author. His hundreds of articles that have been written in scholarly journals and most of the leading financial economics magazines. You'll read something about Dr. Allan Meltzer, and he's been a great champion for us here at the Tepper School. In 2012, he published this book, Why Capitalism? It's a more popular version of some of his strongest ideas, and he has communicated those to our alumni community. We took him on a little alumni tour around the country, and I did a great job in some of our key markets. And those videos, if you want to look at some of the videos and see what did he have to say about this, we got those online. So as part of our Tepper School Alumni Lifetime Learning, you can have a chance to do that. And to show you that he's very much up to speed on everything that's going on, we launched a Tepper School faculty webinar series. And Dr. Allan Meltzer spearheaded that for us. He was the first one to do it for us. So he's certainly in the high-tech age as well. Had a great thing. We sold that out in just an hour or 2 after we posted it on the web for our alumni, and it was a great presentation. So if you're interested in that as too, you'll be able to find that on the website and listen to the audio version of that and see some of the slides from that. But you're actually going to get a great presentation on that very much today, and you see that up there. He's also chaired some wonderful institutions, the International Financial Institution Advisory Commission, known as the Meltzer Commission, focusing on international finance and the IMF. He is the founder and the chairman of the Shadow Open Market Committee that continues now meeting twice a year and giving their perspective on it. He began teaching in 1957. So for those of you very quantitatively inclined, you'll already know that he's been teaching here for 57 years. It's been an amazing, amazing career. And he is actually still teaching now in Mini for teaching his class on capitalism. So if you were a current MBA student in your second year, you'd have a chance to have Dr. Meltzer in person. So it's an incredible legacy. He's one of the great treasures that we have here at Carnegie Mellon University, and it's my honor to be able to introduce him and let him share his insights with you this morning. So join me in welcoming Dr. Allan Meltzer.
I'm not sure I like being a treasure, but thank you. This talk, I changed the topic of this talk. It really isn't a change, a total change. That is, we're going to talk about problems in Europe and the United States. I'm going to talk about a particular problem. It happens to be the problem that interests me a great deal these days, and I'm going to talk about what I'm doing about it because I think something has to be done. It is a great threat to our country. I believe there are lots of threats to our country. This is a great threat, an insidious threat. It's called regulation and the rule of law. Let me tell you a story about the rule of law, and then I'll tell you a more formal give you a more formal statement. How many of you remember that when Ronald Reagan became president, one of the first things he did was to fire the air traffic controllers? Remember that? Yeah. Here's a story that Ed Meese, who was his friend and advisor, told me. How did that happen? As usual, they were sitting around discussing the problem. What should they do about the air traffic controllers who were on strike? And after various people had expressed their views, President Reagan said, well, doesn't everyone in the federal government sign a statement saying that he will not strike against the federal government? And isn't there a law that says they're not allowed to strike against the federal government? Attorney General said yes. Discussion went on. After a while, President Reagan said, doesn't everyone who works for the federal government sign a statement that says he will not strike against the federal government? The answer was yes. So President Reagan said, what are we talking about? It's the law. We'll enforce the law. That's the rule of law. We enforce the law. Now, the fact that there was so much discussion suggests that we don't always do that. And right now, we don't do it very much. So we're losing the rule of law. And the rule of law is fundamental. It's what made America, America. It's what helped us, enabled us to go from a small group of settlements along the east coast of the United States to being the world's leading nation. It's the rule of law that protects property rights, that protects individual rights, that is emblazoned on the Supreme Court building in the statement, equal justice under the law. Everybody, to the extent humanly possible, is treated the same. That's changing, has changed. I discussed with a constitutional lawyer, a leading constitutional lawyer, when I started the project I'm going to tell you about, called Regulation and the Rule of Law. I said, you know, we're losing the rule of law. He said, losing? It's gone. Well, I think that overstates the case, but we are losing the rule of law. How do we lose it? We lose it because we don't treat everybody the same. Here's an example, one that we're working on, as you'll see. Banks, let me say, when I started this project, I'm doing it with my colleagues at the Hoover Institution because I'm borrowing some of the talent from the Stanford Law School, which is one of the United States' leading law schools. And I have there some colleagues who are specialists in constitutional law that are a real source of support. And I spend some of my time trying to learn constitutional law. At this point, I'm reading law books. The example I'm going to give you is one of many. The first thing we did when we started this project that I'm going to talk about in a bit, the first thing we did was to try to think about what were some of the major topics. It's a long list. You know, it's the Environmental Protection Agency, making special privileges and special requirements. It's the National Labor Relations Board. It's a whole host of agencies. And the one I'm going to talk about is something called Too Big to Fail, which is in the banking system. And because it illustrates the problem very nicely. The leading banks in the United States since the 1970s, only since the 1970s, have been called too big to fail. At first, they never described which banks were too big to fail. Gradually, it's narrowed down to where probably the 6 or 7 largest banks in the country are too big to fail, but then a whole host of other institutions have become too big to fail. What does that mean? Well, for one thing, it means that when they fail, taxpayer money, your money, my money, gets thrown in to bail them out. That's just part of the problem. A bigger part of the problem is that because they're known as too big to fail, or thought to be too big to fail, they can borrow in the market at lower rates. So they have a special privilege. That's a violation of the rule of law. And it has big economic consequences. Back in the 1950s, when we didn't have too big to fail, the largest banks in the United States had about 10% of the loans. They now have about 50% of the loans. How did they get there? Well, because they had this special advantage, they could do things that the next size banks couldn't do. So the next size banks couldn't compete with them. What did they do? They sold out to them. So that we've had all these bank mergers that have just absorbed the next largest group of banks into the largest group of banks. That's how they got to 50%. So before they were too big to fail, now they're bigger. That's a problem, but it's a problem that gets repeated over and over again in regulation. Some people get special privileges. Years ago, probably 5, 10 years ago, I gave a talk at the Council on Foreign Relations in New York. The council is supported by Wall Street for the most part, and so many of the members of the audience were people from Wall Street. And the burden of my talk was about crony capitalism and circumvention of the law. How do big companies read the law and then change it, adapt it to their advantage? Violation of the rule of law. Well, the first question that came up in the question period was a lawyer. He said, I'm a lawyer, I work on Wall Street. Who do you think shows them how to circumvent? We do. I wasn't surprised at that. That had been the burden of my talk. What surprised me was the enthusiasm with which he said it. Here was a man saying, look, Congress passes laws, and we found ways to make them not apply to us. They apply to other people, but not to us. That's a violation of the rule of law. And we have that coming out of our ears. I mean, all over the... In addition to that, we now have... How long has this sort of thing gone on? Well, it was Thomas Jefferson, the 3rd president of the United States, who at his inauguration said, I will not enforce the Alien and Sedition Acts. Now, I don't like the Alien and Sedition Acts, and Congress soon repealed them. But what the president said was, I will not enforce them. All the way up to George W. Bush now have signing statements, that is, where the president signs the law into effect and says, I will not enforce these parts. Where does he get that authority? He doesn't. The Constitution says Congress passes laws, and the president and the administration faithfully execute the laws. It doesn't say that they can decide which laws they faithfully execute, and it doesn't say that they can, as the current president does, change the law. That is, say, well, we're not going to enforce this mandate or that mandate, we'll do it 2 years from now. Where do they get that authority? They don't. So how do they get away with it? Well, that's one of the reasons why I've been studying constitutional law. It turns out as so much in law, it depends upon something called standing. In order to sue, you have to have standing. Who gets standing? Well, it turns out there was a case called Frothingham back in the 1920s, which said that only people, individuals, can have standing, and they have to show that they've been damaged. Well, it's hard, if the president just announces it, to show that you've been damaged. So no one has standing to sue. That's how we get away with it. I asked my Stanford colleague, one of my Stanford colleagues, who's the former circuit court judge in the federal system and is now the head of the Stanford University program on constitutional law, I asked him, how does that work? Why can't they just change Frothingham's decision? He says, well, some decisions have the standing of constitutional prohibitions and that it can't be changed. So I came back and said, well, can't Congress change it? Because Article 3 of the Constitution says Congress has the right to make rules for the judiciary. He said, yes, Congress can change it, but it most likely never will. So we lose the rule of law, and we lose the opportunity to prevent them. Now, I'll give you some other examples of violation of the rule of law. When Chrysler and General Motors went into bankruptcy, the decision was made to scalp the bondholders. I mean, that was the first time that it ever happened. They just said, well, you're not going to get the settlement that you should get in the bankruptcy because we want to preserve the union's pension plans. So we're going to scalp you for their benefit. That's a violation of the rule of law. We have the Affordable Care Act, full of cross-subsidies that people don't like. We've been through this many times with different health care programs under President Truman, President Nixon, even President Reagan, President Clinton. Now, all of them failed largely on the basis that people don't like cross-subsidies. We have a consumer protection agency built inside the Fed. Imagine this. Someone is appointed to head the Consumer Protection Agency. What they're supposed to do, what they're ordered, recognized as able to do, is to give loans to underfinanced minorities. Where do they get the money? They take the taxpayers' money. The Fed owns a huge stock of government debt. So they take some of the earnings on the government debt that the Fed has without Congress agreeing on the appropriation or even having anything to say about the appropriation, and use it as the administrator of that agency chooses. That's a violation of the rule of law. So there are just all sorts of these violations, and that's what has had me interested and exercised. So I've started a project. So let me tell you what the formal statement of the rule of law is. And then the rule of law, this is written by a famous lawyer. The rule of law at its core, requires that government officials and citizens are bound by and act consistent with law. Law must be set in advance, be prospective, be made public, be general, be clear, be stable and certain, and be applied to everyone according to its terms. That's what we're losing. And that, as I said, is fundamental to the American system, where every day, just about every day, you read about some special provision that was made and which treats some people differently than others. So what are we doing? Well, we have a project called, strangely enough, Regulation and the Rule of Law. And we began by narrowing down the topics to two, which will be the first two of what I expect will be a multi-year project. I've signed a contract with the Hoover Institution to continue there for 3 more years, so it'll go on at least that long. At that point, I'll be almost 90, so it may be time to we'll see when it comes. I'm sure I can assure you it'll look different then than it does now. So we started on 2 different topics. The first one is constitutional, the one I described a bit a moment ago. We're going to look into what we can do to get back toward the rule of law, to challenge the question of standing, and as part of that, to investigate the regulatory agencies. Now, you all learned at some point in your grammar school education that we are a government of laws and not of men or women, and that's not true, because we're not a government of laws when we violate the law as often as we do. But you also learned that there is a system of checks and balances. You know, we have a president and a Congress, and you don't need to be very much up on the details to know that they don't quite get along. We have a judiciary to oversee what they do, and which, under the early head of the Supreme Court, Marshall, seized the position of saying, we decide what the law says. So checks and balances. Now we have grown up a whole host of regulatory agencies. What do? Well, they regulate, they decide on the regulation, they enforce the regulations, and they decide about the violation. That is, they perform the administrative, the legislative, and the judicial function. Where are the checks and balances? Nowhere. They are governed by something called the Administrative Procedures Act, which says what they can and cannot do. But the Administrative Procedures Act was written in 1946 and hasn't been changed. And we have a heck of a lot of new regulatory agencies that have been built up in that time and that have expanded their powers. So we have 2 constitutional lawyers, 2 very famous constitutional lawyers, writing papers on how should the Administrative Procedure Act get along. Now, where is that going to go? Well, I don't know. But what we're going to do is, I think I told you that one of the people who I'm working with is a former circuit court judge, and he has agreed that he will bring other judges to the meeting to hear these papers. So we have a chance of getting members of Congress and members of the judiciary to at least listen to our solutions to what we think are serious problems. And one of those serious problems is to put a rein on regulatory authority. That is, to make them subject to much more restriction so they can't just do whatever it is that comes to mind. The challenge is to government control without government ownership. And that's what regulation is. Now, it's not an anti-regulation. That is, I'm not opposed to regulation. I'll go back to Too Big to Fail to explain how I think you want to regulate. It has to do with incentives. I told you about the lawyer in Wall Street and how they circumvent the law. Well, as near as we can, we'd like to get laws which can't be so easily circumvented. every economist learns early that there are private and social costs, so we need regulation to bring together the private and social costs. That's why I'm not against regulation. What I'm against is regulation which transfers authority to people to make arbitrary decisions which favor some and oppose others. How would we deal with too big to fail? Well, there I at least have some scars. I testified 4 times in the Dodd-Frank hearings on too big to fail, and now in January of this year, a 5th time. In one of those meetings, several of those meetings, I proposed a way of regulating banks. It's a simple way, it's a time-honored way, it's the way we used to do it back in the before we had a big government. That is, we said the banks had prudent policies which were enforced by the fact that they held 15 to 20% equity capital. So in the Great Depression, the worst period of banking history in the United States, from 1929 to 1932, not a single large New York bank failed. They held 15 to 20% equity capital. How much equity capital did they hold in 2008? Well, some of them were down to 1 or 2%, and they met their capital requirements by having bonds. But then they insured the bonds, so they had, to use the vernacular, no skin in the game, or very little, and they didn't care about the risks that they were taking. That's not a good system. It's not good from their standpoint, but it's certainly not good from ours. So I recommended that we go back to 15% equity capital. Senator Vitter, a conservative Republican from Louisiana, asked me to come in and talk to his staff about how we could implement that. And of course, and so he wrote a bill, and he got a bipartisan bill because he got Senator Sherrod Brown of Ohio, who's a very liberal Democrat, to sign on to the bill, and it's now the Brown-Vitter bill, and it's in the Congress, in the Senate. And at the last hearing that I went to on this, which was in January, one of the senators asked the witnesses, who were represented a political spectrum, asked them, does the Dodd-Frank law, the new law on regulating banks, does it in fact prevent too big to fail, get rid of too big to fail? And the answers were, there were 4 of us, the answers were no, 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 and no. That is, people answered the question not from their political perspective, but from their understanding of economics, because they were all economists. And that was helpful. At the end of the hearing, Senator Brown came up to talk about the hearing, and I asked him, are we making any progress on this? And as he said, which tells you where the problem lies, he said, well, you know, the New York banks have a lot of economic and financial clout, so it's very hard to move the regulation. Well, recently, just this week, my friend Tom Honig, who is the vice chairman of the FDIC, managed to persuade the Federal Reserve and I think the controller of the currency to increase the capital requirements for banks, not up to 15%, but to increase them from where they were, and that's especially for large banks. So that's a step in the right direction. It may not be enough, but it's better than where we were, and it requires them to hold equity. It doesn't have the other really important thing. It doesn't have, the banks like to do this by having risk-based capital because they can use that to circumvent the regulation. My proposal was get rid of risk-based capital, put it on all the assets, and the banks complain that, well, it's not worth holding some of these assets. And the answer to that is sell them. That's what markets do. Sell them. You know, you don't think it's a good investment? Sell it. Unfortunately, we didn't get that, so we do have some risk-based capital requirements, and that will give us circumvention. It's better, not good yet. So that's the way I want to regulate. You want to regulate so that you give the incentives to the group that is regulated to do the things that you regard that you're trying to achieve. That you don't want to leave to them to decide how they're going to do it. You want to tell them how they have to do it. And that's where we get back to the rule of law. Because if we have equity capital requirements which apply to all the banks, not equally to all of them, because some of them are protected by deposit insurance, which banks finance out of their own money. So they don't need the same requirements, but to all those who are in the class, the rules are the same. That's getting back toward the rule of law, and the objective that I have is to see how much of that we can do. I don't believe it'll be easy. I believe the reasons it isn't easy are obvious. There's political pressure everywhere to avoid raising these costs. But it's a fight worth fighting, and that's what we're trying to do. So one part of our program is to have some research and attention to too big to fail. The other part is to have some attention to the constitutional issues, and then we'll go on to many other issues, probably things like environmental legislation, which is just a mass of special privileges and prohibitions. And if I have the stomach for it, healthcare. Anyway, there's an endless amount of things that we can do, and that's what we're doing. Now, I changed the topic in a way from the problems of Europe and the United States, which are mainly macroeconomic problems, that I was going to talk about, because I thought this was something that is dear to my heart and close to my mind, and it occupies me almost daily. And we're beginning to make some progress in getting our conferences organized, and we will have them next year. What we'll accomplish remains to be seen. I've been in the public policy arena for enough years to know that none of this comes easy. When we started the Shadow Open Market Committee in 1973, it was 6 years before we heard Paul Volcker say, I'm a practical monetarist. He picked up many of the ideas that we had advocated, and he had the courage to stay with them and implement them, and that's what it takes. Now, what brings about change, my view from working in this for many years, is it takes a crisis. The role, and I'll end with this and then answer some questions, the role of economists is, at least as I see it, is to come up with solutions to the problem and make them understandable to the public, get support for them. That was the purpose of the Shadow Open Market Committee. That's the purpose of the Carnegie Rochester Conference, which I started to bring together regulators. That's what we're doing with the Rule of Law program, bring the regulators together with the researchers, get a discussion going, get people familiar with the ideas, get them to talk about them, to raise their criticisms, to have the thing aired. Then when the crisis comes, you have a proposal which makes sense. I'll illustrate that with a story that's familiar to many of you, about the volunteer army. As you know, we have a volunteer army. how did we get the volunteer army? Well, there was a crisis. It's almost always a crisis to get change. It takes a crisis to get change. Economists had worked out the volunteer army. A good friend of mine, Walter Oy, a Japanese American, blind most of his life, did remarkable work for a blind person, and he had done careful econometric work and had worked out how much the Army would have to pay for an all-volunteer Army. And he had an econometric estimate of the cost. And when President Nixon was President-elect Nixon, there was a crisis. People were burning their draft cards. Young men were going to Canada. The alternative proposal, the proposal for what it at the time was to get rid of the draft as it was and replace it with a lottery. I think that's a crazy idea. If you win the lottery, you get to serve in the Army. But that was the alternative. So President Nixon had them organize, President-elect Nixon had them organize a conference at which the military, some of the principals in Congress got together, and Milton Friedman convinced them about the benefits of an all-volunteer army using the work that Walter Oy had done as the basis part of his argument. They weren't convinced that it was a solution to their problem, but it was sure better than the lottery. That's how we got the volunteer army. That's how we get change. It isn't necessarily that people who are making the change think that this is an all-time great idea. It just has to be better than the alternatives. So that's what we're trying to do, and that's my current project and that I live with every day. And so let me stop there and answer questions about what I've been talking about, or to close the circuit on economic policy in the United States and Europe, answer questions about that if you have them. Thank you.
Questions?
So, Professor, you mentioned what happened to the bondholders in the
Chrysler.
bankruptcy of GM and Chrysler. And prior to that, in your talk, you mentioned that you have to have standing in order to sue. One of the things I never understood, why didn't the bondholders in that case sue? They clearly had standing.
Yeah, I don't know. I don't know the answer to that. I talked to one of the people who was there and who was involved. He worked for Chrysler. And he couldn't give me an answer as to why they didn't sue, so I don't know. It clearly set a terrible precedent. Yes, and it's, as you know, I think a terrible violation of the rule of law. We didn't treat them the way we should treat, way the law required that all bondholders be treated. We did something different. We gave away the Chrysler Corporation to an Italian company, Fiat, in exchange for a promise that Fiat would produce small cars in the United States. They didn't pay anything for the majority rule. They later bought the rest of the company and paid for it, but they didn't pay anything for buying the Chrysler Corporation. They just gave a promise that they would keep the company running and would produce small cars in the United States. Yes.
How does the increase in global competition from other financial institutions impact the ability to raise the equity requirements on American banks?
Not much. It's a complaint. Switzerland has 19% equity capital requirements. Britain is somewhere up there also now. So other countries are doing those things. And the more likely result is that if we raise the equity capital requirements, the European Union will follow us. If they don't follow us, will they have an advantage? Maybe, but it won't be great. The banks say we will be at a disadvantage because we won't be able to produce credit. That's wrong. I mean, just totally wrong. It's the Federal Reserve that decides how much credit there is in the economy, not the banks. The banks decide who gets the credit. The Federal Reserve decides how much it is. Now, the large banks will have a smaller multiplier on reserves, but there'll be more reserves. So others will supply the credit, and that will produce more competition. So that's, as far as I'm concerned, is a good. Now, all of you are graduates of this school, so you certainly ran into the Miller-Modigliani theorem. It says, remember, it says the composition of the assets, of the liabilities, has nothing to do with the composition of the assets, and conversely. So if we make them hold more equity, it's not going to change the composition of their balance sheet. It'll be smaller because more equity will be there. But now there are some exceptions to Miller-Modigliani, but they're not important. The Miller-Modigliani theorem applies to banks just as it applies to corporations. The composition doesn't matter. So the answer is the bank arguments are simply wrong. All right, self-serving, and I've been around long enough to know that self-serving arguments are often persuasive, but that doesn't make them right. Yes?
What do you think would be the direction of the Federal Reserve in the future?
Oh, I think it's supposed to be an independent agency.
Right.
You know, as John mentioned, I wrote the history of the Federal Reserve. You can look through their minutes, as I have, from the time that they began to the present. You won't find many descriptions of what it means to be an independent agency or what they mean by independent. After all, they financed 2 wars. They quadrupled the size of their balance sheet in the last 5 years. They financed, that's pretty independent. On the other hand, they financed the government's debt. That's not independent at all. So it's a very mixed bag. The only definition that there is in the Federal Reserve minutes comes from a chairman named Martin back in the 1950s and 60s. And he said, we are independent within the government, not independent of the government. Well, that interested me. What the devil does that mean? Well, he explained what it meant. It meant when the government runs a deficit, it's passed by Congress and signed by the president, so we have to help finance it. Well, that's not independent at all, because it says, here is my statement about the current policy. I do not know any time, any place, any country, ever, that's a strong statement, and I mean it as a strong statement, that had large budget deficits, as we do, financed by printing money, as we do, that didn't have an inflation follow. Never. If we do it this time, it will be the first time anywhere, ever. So I'm not very optimistic about that. When? Who knows? We have, let me say that we have sitting on the balance sheets of the banks $2.5 trillion worth of excess reserves. We've never had anything like that, ever. No one could even imagine that we would ever have that, but we do. So the banks can just expand as large as they want. The Federal Reserve says, when I talk to my friends at the Federal Reserve, and I have a few, they say, well, we'll just raise interest rates. So the obvious question is, how high? How high? Well, they say as high as necessary. Wow, as high as necessary. Does that mean back to 20%, the way it was in the Volcker years? You know, once you get above 5 or 6%, you begin to hear from the labor unions, from the business community, from the public, from the Congress. You know, it becomes, will they have the guts to keep going? I don't believe they will. So, but we'll see. We'll see. It's true that they could, by raising the interest rate enough, get the banks to hold on to those excess reserves for a long time, at the expense of killing the economy, perhaps. Not a very good choice. When I say they've been financing deficits, let me give you the picture. Paul Volcker, who ended the inflation in the 1980s, financed 9%, only 9% of the Reagan deficits. Ben Bernanke, and the Reagan deficits were large for the time, but the Obama deficits are orders of magnitude larger. And Ben Bernanke financed not 9%, but 43%. So we have huge deficits financed by a lot of money. And that money is sitting idle on the bank's balance sheet for the most part, but it's beginning to come off now. And when will it break out in inflation? Who knows? The next step, I believe, will be a rise in food prices because of what I can only describe as an insane environmental policy. Farmers in California, in the Central Valley of California, are not planting crops. They're not planting crops. They produce 50% of the crops, the garden crops, fruits and vegetables that we all consume. 50% of them. They're not planting. Why are they not planting? Because they had a drought, and they don't have water. Where now they've had some rain and some snow, but the water, the Environmental Protection Agency says the water, a great part of the water has to go into the river because of some fish called the snail darter that swim at the mouth of the river. So the water runs into the ocean to protect the fish, and the farmers say without water we can't plant, so they're not planting. That's going to raise food prices. When that happens, you'll see all over that the pundits will say, well, it's just food prices that are rising, it's not a general inflation. Let me say that in 1966, I talked to Danny Brill, who was the head of research at the Federal Reserve, and I talked about the inflation. He said, Allan, don't worry about the inflation, it's just food prices that are rising. Well, so we're going to see a repeat of that, I believe. That will be the first step on a long path and not a very attractive one. Other question?
Well, I wish we could take more, but we're going to have to close down our time, and if you want to have a few personal words with Dr. Meltzer, you're more than welcome. But let's thank Dr. Meltzer for
Thank you for coming. Always a pleasure to see you.